All right, let's cut across live now to P Chidambaram, the union minister. They're coming out, in fact, addressing a gathering there. Let's listen in.
And dampening the prospects of an upturn in the global economy. The world economy achieved a GDP growth rate of 5.3% in 2010. The rate of growth declined to 3.9% in 2011 and is expected to decline further to 3.5% in 2012. The rate of growth of advanced economies halved from 3.2% in 2010 to 1.6% in 2011 and is expected to decline further to 1.4% in 2012. As can be expected, the Indian economy has not been immune to these developments. It registered a growth of 6.5% during 2011-12 in terms of gross domestic product at factor cost at constant 2004-05 prices, and in the first quarter of 2012-13 the provisional estimate of growth is 5.5%. However, we would do well to remember that out of 8 years, it is only in 2 years, I repeat, out of 8 years, it is only in 2 years, that is 2008-9 and 2011-12, that the GDP grew at below 7%. It is indeed a matter of concern that the growth rate dipped in 2 years, but there is no cause for gloom or despondency. I may point out that even at a low growth rate of 6.5%, India was among a handful of countries that recorded significant growth in that year. The slowdown in growth is attributable mainly to the global economic situation, high commodity prices, inflation, and a decline in investment. Government responded to the declining trend in the growth rate by increasing public expenditure. However, in the absence of matching revenues, a rise in expenditure led to a rise in the fiscal deficit. Inflation also rose. The burden of containing inflation fell largely on the central bank. The Reserve Bank of India was obliged to follow a tight monetary policy. Overall inflation declined from 9.8% in August 2011 to about 7.55% in August 2012, but still remains unacceptably high. A tight money policy has dampened investment as well as growth, particularly in the industrial sector. I think all of us would do well to note the limitations of monetary policy action. It is government's firm belief that fiscal policy and monetary policy should work in tandem so that the common objectives of containing inflation and stimulating growth are achieved. Let me say a few words on inflation. It has been an issue of persistent concern over the past few years. We have seen some moderation in recent months. Inflation, measured in terms of WPI, has been in the range of 7 to 7.6% in the recent months as a result of the measures taken by the government and the Reserve Bank of India. WPI inflation in August 2012 stood at 7.55%. However, with food inflation continuing to be high, we must take more steps in order to contain inflation. Growth comes from higher investment. We achieved a high investment rate of 38% in 2007-8, and in that year, the GDP grew at 9.3%. Hence, the foremost task before us is to promote savings, channelize the savings into investments, and achieve a rate of investment of 37 to 38% of GDP. At that level, given India's incremental capital output ratio, I am certain that growth will recover to 8% or more and perhaps touch 9%. While it would be premature and ambitious to talk of 9% growth, we should keep that rate of growth as our objective and progress towards achieving that objective. It is in this context that the 12th plan has projected an average growth rate of 8.2%, with growth in the terminal year projected at 9%. Long-standing structural reforms required to achieve high investment and high growth rates have been held back because of many reasons.